Welcome to the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamoen. In this podcast, we cover the latest developments, trends, and regulatory changes affecting the real estate and mortgage industry in Ontario. Whether you're a homeowner, aspiring buyer, or real estate professional, we're here to provide you with the insights you need to make well-informed decisions. Today's episode is packed with vital information. We're going to discuss the significant drop in Toronto real estate sales, the decline in Toronto area home sales in August, the combined value of Ontario real estate, the potential for borrowers to see the lowest 5-year fixed rates in more than 2 years, and an important alert from the Financial Services Regulatory Authority of Ontario. So, let's dive right in. First up, let's talk about the most alarming news. Toronto real estate sales had the worst month in 24 years, and prices dropped by $15,000 over just 31 days. According to the Toronto Regional Real Estate Board, the market continues to erode, defying expectations that it would firm up this year. August saw one of the worst months on record for sales, with prices taking a significant hit as inventory levels climbed to rarely seen heights. The benchmark price for a typical home across the Greater Toronto Area fell by 1.4%, or $15,100, to $1,082,200 in August. This price drop takes us back to levels similar to October 2021. Over the past few years, prices have mostly moved sideways, showing little to no growth. It's important to note that while annual growth may appear to have improved due to a base effect, prices are still very much in decline. The benchmark price in August was 4.6% lower than the same time last year. This might look like an improvement from the previous month, but it's merely because prices fell less in August 2024 compared to the previous year. Home prices are now 17.6% lower than the record high reached in March 2022, a drop of $231,600. Greater Toronto's real estate market is struggling due to a total lack of demand at current price levels. Sales fell by 5.3% from last year, totaling just 4,975 homes sold in August. This is the fewest sales in August since the year 2000. When we look at the year-to-date numbers, the total sales are the lowest since 2001, a time when the board was much smaller and the population in the Greater Toronto Area was significantly less. Despite the downturn, sellers are still eager to exit the market. New listings for the month climbed by 1.5% to 12,547 homes in August. This surplus of listings pushed the total active inventory higher for the 5th consecutive month to a staggering 22,653 homes for sale. This is a 46.2% increase from last year and the highest level of active inventory in August in at least a decade. The combination of fewer sales and more new listings has further eroded the sales to new listings ratio, or SNLR, which is a fundamental indicator used to determine the strength of demand in the market. In August, the SNLR for Greater Toronto stood at 39.7%, categorizing it as a buyer's market. In industry terms, this means that if this trend persists, prices are expected to fall even further. The real estate industry in Greater Toronto has expressed optimism that demand will pick up next year. However, it's worth noting that similar predictions were made last year, and the market has only shown further signs of weakening. In the meantime, negative data continues to accumulate, and demand for new homes has reached a record low. Next, let's talk about how Toronto area home sales declined in August, but a potential rate cut might spur some activity. According to the latest data from the Toronto Regional Real Estate Board, home sales in the Greater Toronto Area fell significantly in August, continuing a downward trend that has been evident for several months now. The board reported that a total of 4,012 homes were sold in August, which is a 5.7% decrease compared to the same period last year. The decline in sales is largely attributed to higher borrowing costs, which have made it more challenging for potential buyers to enter the market. The Bank of Canada has maintained its key interest rate at 5%, but there are growing speculations that a cut might be on the horizon. Many industry experts believe that a rate cut could potentially bring some relief to the market and encourage more buyers to step in. Interestingly, Despite the drop in sales, the average selling price for homes in the Greater Toronto Area remained relatively stable. In August, the average price of a home was $1,082,400, which is virtually unchanged from the previous month and only slightly lower than last August's average of $1,085,000. This stability in prices is partly due to the limited supply of homes available for sale, which has helped to support prices even as demand has waned. The Toronto Regional Real Estate Board also noted that the number of new listings in August was down by 1.8% compared to last year, totaling 11,237 homes. This decline in new listings has contributed to the tight supply conditions that are helping to keep prices relatively stable. However, the board warned that if borrowing costs remain high and economic uncertainty continues, the market could see further declines in both sales and prices. One of the key factors that could influence the market in the coming months is the Bank of Canada's decision on interest rates. If the bank decides to cut rates, it could provide a much-needed boost to the market by making borrowing more affordable and encouraging more buyers to enter the market. On the other hand, if rates remain unchanged or are increased, it could further dampen market activity and put additional downward pressure on prices. The board's president, John DiMichele, emphasized the importance of government intervention to address the housing affordability crisis. He stated, "We need all levels of government to work together to increase housing supply and make home ownership more attainable for more people. This includes measures to reduce red tape, increase the speed of approvals for new housing projects, and provide more support for first-time home buyers." In summary, while Toronto area home sales have declined in August, the potential for a rate cut from the Bank of Canada could spur some activity in the market. However, the overall outlook remains uncertain, and much will depend on the actions taken by both the government and the central bank in the coming months. Let's shift our focus to the latest data on the combined value of Ontario real estate. According to the Municipal Property Assessment Corporation, the total value of all real estate in Ontario is now estimated at a staggering $3.4 trillion. This marks an increase of $42 billion compared to the previous year. The significant rise in property values can be attributed to a variety of factors, including new construction projects and ongoing demand for real estate in key areas. For instance, new development sites like the one at 407 Dundas Street West in Oakville have played a crucial role in driving up the overall value. Oakville, known for its affluent neighborhoods and high-quality amenities, continues to be a hotspot for new developments. Toronto alone has seen its property values rise to a remarkable $993 billion. The city remains a focal point for both residential and commercial real estate, attracting investments from both domestic and international buyers. The continuous influx of people moving to Toronto for its diverse job market, educational institutions, and vibrant lifestyle has kept demand high, further pushing property values upward. It's worth noting that the Municipal Property Assessment Corporation's estimates are based on a comprehensive assessment of various property types across the province. This includes residential, commercial, industrial, and agricultural properties. The organization uses a range of data analytics and market trends to arrive at these figures, ensuring a high level of accuracy in their assessments. The rise in property values is not just a reflection of market demand, but also of the broader economic conditions in Ontario. The province's economy has shown resilience, even in the face of global uncertainties. This economic stability has made Ontario a desirable location for real estate investments, further contributing to the increase in property values. However, with rising property values comes the challenge of affordability. As property prices continue to climb, it becomes increasingly difficult for first-time home buyers to enter the market. This has prompted calls for more affordable housing solutions and government intervention to ensure that the real estate market remains accessible to a broader range of people. In summary, the combined value of Ontario's real estate now stands at an impressive $3.14 trillion, driven by new construction, high demand, and economic stability. While this is good news for property owners and investors, it also highlights the ongoing challenge of affordability in the real estate market. As we move forward, it will be crucial for all stakeholders, including the government, to address these issues to ensure a balanced and inclusive market. Borrowers could soon see the lowest 5-year fixed rates in more than 2 years. Canada's central bank recently made a quarter-point rate cut, bringing the benchmark prime rate down to 6.45%. This move is directly benefiting floating-rate borrowers and could signal more good news ahead for those looking to lock in fixed rates. Leading variable rates are now as low as 5.15% for those who are default insured, with some lenders like Nesto offering these competitive rates. For uninsured mortgages, the rates are slightly higher, starting at 5.60%. Home equity lines of credit, or HELOCs, have also seen a drop, with many lenders now offering rates starting at 6.95%. If you're highly qualified, you might even be able to negotiate a lower rate. This is a significant shift for borrowers who have been grappling with higher interest rates over the past few years. The same economic forces pushing the Bank of Canada to cut rates are also benefiting fixed-rate borrowers. Fixed rates are closely tied to bond market yields, which have been declining rapidly. One key indicator, the yield on Canada's 5-year government bond, has sunk to a 17-month low. This decline in bond yields usually leads to lower fixed mortgage rates. As a result, we could soon see 5-year fixed rates drop to as low as 3.99% for the first time in over 2 years, at least for insured mortgages. This is a welcome change from the peak rates of 5.54% we saw around this time last year. For those looking to take advantage of these lower rates, now might be a good time to start planning. Whether you're looking to refinance your existing mortgage or enter the housing market for the first time, the potential for lower rates could make a significant difference in your financial planning. In summary, the recent rate cut by the Bank of Canada and the resulting drop in bond yields are paving the way for potentially the lowest 5-year fixed mortgage rates we've seen in more than 2 years. This is an opportune moment for borrowers to reassess their mortgage options and consider locking in these favorable rates. Now let's move on to an important alert from the Financial Services Regulatory Authority of Ontario, or FSRA, that could impact many homeowners. FSRA has issued a warning to mortgage professionals about expired notices of security interest, or NOCs, that may still appear on homeowners' property titles. These NOCs were commonly used for consumer goods like water heaters and HVAC units to protect businesses' interests, but are no longer valid due to recent legislative changes. Under Ontario's newly passed Homeowner Protection Act, NOCs related to consumer goods can no longer be registered in the Land Registry. FSRA is urging mortgage agents, brokers, and brokerages to make sure their clients are aware of this change and to protect them from making unnecessary payments to businesses trying to collect on expired NOCs. In a recent news release, FSRA explained, a business may put a NOC in place to protect its security interest in the good or equipment and may repossess that equipment if a homeowner defaults on payment. It is a common business practice. The registration is permitted under the Personal Property Security Act and is often inaccurately referred to as a lien. These NOCs were traditionally used by businesses to secure their interests in rented or financed goods installed in homes, such as furnaces or water heaters. They allowed companies to repossess the equipment if a homeowner defaulted on payments. However, many homeowners were unaware of these registrations until they attempted to sell or refinance their properties. In some cases, businesses charged excessive fees to discharge these NOCs. Antoinette Leung, head of financial institutions and mortgage brokerage market conduct at FSRA, stated, "While FSRA does not regulate land registrations, we want to help mortgage professionals protect homeowners from paying fees for notices of security interest, NOCs, that are now expired and help them avoid unnecessary financial stress. We expect mortgage professionals to make their clients aware of expired NOCs and advise their clients appropriately to prevent any further potential consumer harm." FSRA's latest warning comes after previous reports of homeowners being victims of scams related to home improvement contracts and new liens on their properties. For NOCs registered before June 6, 2024, homeowners are advised to consult with a lawyer if they wish to have the NOC removed from the land title system. In summary, mortgage professionals need to be vigilant and proactive in informing their clients about these expired NOCs to prevent any unnecessary payments or financial stress. This is a crucial step in protecting homeowners and ensuring they are not taken advantage of by businesses trying to collect on invalid notices. That wraps up today's episode of the Ontario Mortgage and Real Estate Insights podcast. We covered a range of important topics, from the significant drop in Toronto real estate sales to the potential for the lowest 5-year fixed rates in over 2 years. We also discussed the combined value of Ontario real estate and the recent alert from FSRA about expired notices. Thank you for tuning in, and I hope you found this episode informative. Until next time, I'm Steve Hamoen, wishing you all the best in your real estate endeavors.